Economic activity is likely to also contract in the United States and Europe as governments there take actions to contain the spread of the virus. In financial markets, the sustained global bull market in equities and corporate bonds also ended dramatically last week, with extensive and deep repricing. Prices for emerging market sovereign debt and other risky assets also fell sharply. This will have repercussions for household wealth and income, impacting further on global economic growth. In response to all these developments, the United States Federal Reserve, alongside other central banks, took various steps to provide further monetary accommodation. Additional steps have also been taken to provide liquidity and ensure the smooth functioning of markets. Some governments have taken fiscal measures to mitigate the economic effects of the virus. In light of these considerations, we have marked down global growth for 2020 to 1.1% before it rises to around 2.8% in 2021. While a deeper or longer global and domestic contraction is not in our baseline, the committee did consider a scenario featuring that possibility. Prices for some commodities have fallen as a result of weaker demand globally, with copper and oil being particularly hard hit. The spot price for Brent crude oil is currently around $30 per barrel, but is expected to bounce back to higher levels. For our forecast, the Brent crude oil price is expected to average around $40 per barrel in 2020 and $44 per barrel in 2021, well below previous assumptions. The domestic economic outlook remains fragile. At this point, COVID-19 is likely to result in weaker demand for exports and domestic goods and services, but its impact on the economy could be partly offset by lower oil prices. We also expect disruptions to supply chains and to normal business operations. The bank now expects the economy to contract by 0.2% in 2020. GDP growth is expected to rise to 1% in 2021 and to 1.6% in 2022. Apart from the COVID-19 global pandemic, electricity supply constraints and other sources of uncertainty are expected to keep economic activity muted. Public sector investment has declined and job creation has slowed. Business and household confidence have weakened further. Government and household consumption and private investment, however, continue to grow, albeit modestly. While export growth is expected to decelerate further in the near term, prices remain high for some export commodities and could be supported by an early resumption in China's economic activity. The technical recession of the latter half of 2019 contributed to a lower economic growth forecast. In addition, COVID-19 and existing constraints such as load shedding imply significant downside risk to the forecast. With persistently low inflation and the coronavirus now hitting economic activity, monetary policy in major advanced economies and China will likely remain accommodative over the medium term. Easy global financing conditions have previously supported the value of the local currency, but financial volatility and a sharp rise in perceived risk has caused the rand to depreciate by 17.2% against the US dollar since January. The implied starting point for the rand forecast is 15 rands 30 to the US dollar compared with 14 rands 90 at the time of the previous meeting. The forecast shows the currency strengthening over time, recovering towards its longer-run equilibrium level. The bank's headline consumer price inflation forecast averages 3.8% for 2020, 4.6% for 2021, and 4.4% in 2022. The forecast for core inflation is lower at 3.9% in 2020, 4.3% in 2021, and 4.4% in 2022. With the downward revision to the forecast, the overall risks to the inflation outlook at this time appear to be balanced. Electricity pricing remains an immediate concern, and there is likely to be higher volatility in prices of other goods and services as a result of sharp changes in demand and supply. Risks to inflation from recent currency depreciation are expected to be muted as pass-through is slow and could be offset by a wider output gap. Food price inflation is expected to remain low, in part due to better weather conditions. Expectations of future inflation have moderated further on the back of lower services prices, modest food price inflation, and slower growing nominal wages. Across the different surveys we look at, inflation expectations currently average 4.4% in 2020, 4.6% for 2021, and 4.7% in 2025. Market-based expectations have also moderated, with 5-year break-even rates currently at about 3.9%. Heightened risk sentiment in global markets has amplified domestic and fiscal risks. This has pushed South Africa's sovereign bond yields sharply higher and weakened the domestic currency, increasing risks to monetary policy. The steep drop in global real interest rates implemented by advanced economies in recent days has partly offset those risks. Despite the general rise in risk, the significantly lower forecast for headline inflation has created space for monetary policy to respond to the rapid deterioration in economic conditions. Barring severe and persistent currency and oil shocks, inflation is expected to be well contained, remaining below the midpoint of the target in 2020 and close to the midpoint in 2021. Against this backdrop, the MPC decided to cut the repo rate by 100 basis points. This takes the repo rate to 5.25% per annum with effect from 20 March 2020. The decision was unanimous. The implied path of policy rates over the forecast period generated by the quarterly projection model indicated 3 repo rate cuts of 25 basis points each in the second and fourth quarter of 2020, as well as in the third quarter of 2021. Monetary policy can ease financial conditions and improve the resilience of households and firms to the short-term economic implications of COVID-19. Our decision and its magnitude seeks to do this in the near term. Monetary policy, however, cannot on its own improve the potential growth rate of the economy or reduce fiscal risks. Current economic conditions underscore the importance of implementing prudent macroeconomic policies and structural reforms that lower costs generally and increase investment opportunities, potential growth, and job creation. Global economic and financial conditions are expected to remain highly volatile for the foreseeable future. The committee will continue to assess risks to inflation, including from weaker economic growth and those arising from wage, price pressures, and currency depreciation. As usual, the repo rate projection from the QPM remains a broad policy guide which can change from meeting to meeting in response to changing data and risks. That concludes our statement. The press conference today is virtual because the journalists couldn't be here. As you might appreciate, we have got a national disaster declared, and so we are minimizing the number of people in these rooms. And at this stage, I will turn and take the questions. They will be coming online, and Zianda will be assisting me there. If you could prioritize the media, that is what this is, a media conference.
Governor, 2 questions from Lindley from Business Day. What meetings has the SARB had with major banks or financial sector regarding risks in the financial sector sparked by the crisis, and how concerned is the PA regarding the health of the financial system? The second question, how concerned is the bank and the PA about the risk of either government or major SOEs, e.g. Eskom, and their ability to raise debt under current circumstances?
Okay,
I have a third question, but it's from an analyst, so we'll wait.
No? Okay, there isn't another one from the...
No, that's
okay.
all from the media for now.
We are in constant conversation with banks. In the current environment with the national disaster, the meetings are not physical. We are talking on the phone. We would talk over video conferencing. It's a constant thing. We do that all the time. And it is so because we have got responsibility to oversee the financial system, firstly, broadly. It is also done because we always have regulatory or supervisory issues with each one of the institutions that we supervise. The financial system in South Africa is healthy. It is well capitalized with ample liquidity and meets all the requirements in terms of Basel III, which have been incorporated into our domestic regulations. In the previous crisis, it was precisely because our banking system was strong and well capitalized that allowed us to weather the crisis. Since the introduction of Basel III, the capital and liquidity standards have been strengthened, and the South African banking system meets those standards and is in an even much stronger position than it was in 2008. The current situation is, of course, a trying one, and will constantly test the resilience of the financial system. We have not seen any stresses in the financial system at the moment. The third question had to do with how concerned are we about the ability of Eskom or the Treasury to raise funding. Well, I think that question must be directed to the Eskom and the Treasury as to whether they are concerned about their ability to raise funding.
More questions, Governor, from Bloomberg. One, it's a couple from Bloomberg. One, under what circumstances would the SARB consider using other non-monetary policy tools to provide relief, and what kind of tools would you consider? Second question, what specific steps does the South African government need to take to rescue the economy? How can government stimulate economic growth in the face of the coronavirus shutting down trade, travel, and other activity? Another question, at what time of GFC SARB held monthly MPC meetings. Is that back on the table? Fourth question. The Banking Association has said it is urgently consulting banking regulators and competition authorities to determine how best it can respond to the social and economic impact of the virus. What measures are being considered? Is debt relief or payment holidays on the cards? Will banks have to start proactively restructuring loans?
Okay.
Business day.
No, that is a handful. Can we deal with that so that I deal with this round and then I can start giving the difficult questions to my colleagues.
Perfect.
What other non-monetary tools are we consenting? We have stated we have got monetary policy space and we have used it. So there isn't a need for us to go and consider other tools. The other tools that people end up deploying, they deploy because they are at the zero lower bound. And because they are at zero lower bound, they are having to add to an array of tools. We do have tools in our toolkit that had always been used, whether it is the reserve requirements and the operations that we do to stabilize domestic money markets. Those tools are there for us to use as appropriate, but there is no need for us to be using unconventional tools at the moment. Our conventional tools are just working just fine. What should the government do to rescue the economy? That is a question best directed to government. What should government do to stimulate the economy? That is the question best directed to government. What we could say is that from the monetary authorities' perspective, we have taken the steps within our mandate to mitigate against the risks that the economy is exposed to. And as we had said, is that it would actually strengthen the resilience of businesses and households. Naidu is going to deal with the BASA thing and the competitions authority. During the GFC, we had, the SARB ended up with monthly meetings. That was for a very limited period of time. And it just so happened that the global financial crisis set in like a week or two after an MPC had ended, and the SARB switched to that. At the moment, we do not think that there is any need for us to meet on a monthly basis. The situation is fluid. We continue to assess the situation. Should we be in a position where we feel that we have got to do something urgently, there is nothing that stops us from convening an urgent meeting. But as things stand, there was nothing that necessitated such, and there is nothing that necessitated that we switch to monthly meetings. Naidu?
Thanks, Chair. Chair, I think you've actually answered most of that question. We are in daily contact with the banks and with BASA. We're in daily contact under normal circumstances, but certainly at the moment we're monitoring the banks quite closely. We are being informed of both operational issues in the banking system, such as staff who may get sick and branch closures, but we're also being informed about whether there are any stresses in the system. We feel that the present mechanisms that we have, forums that we have, are adequate to deal with any of those stresses. There are certain decisions that businesses and banks would take off their own accord. We would welcome those. We're monitoring those, and they certainly will discuss those with us. So in that sense, I don't think that there's anything extraordinary, precisely because we do have the mechanisms to deal with such a situation in the normal course of events.
The thing about the competition, BASA talking to the competition authorities.
Chair, I don't quite know how to respond to that. I mean, you know, it's up to the competition authority, or in fact the minister responsible for the competition authority, to amend or gazette any changes to regulations. We talk to the banks generally individually, but sometimes collectively. about these issues. If there is a collective effort from the banks, I think that they are the correct forums and channels to channel that through.
Yes, now.
Okay. Business Times, Hilary Joffe, you've sort of responded to this question, Governor. Is the Reserve Bank planning to do anything to enable the commercial banks to provide assistance to customers in distress? Will you lighten the regulatory burden for banks to enable them to cope with higher rates of default? Business Day, Lucanyo. With much of the economy in lockdown, how effective will interest rates be in supporting activity? Could the bank have announced more unconventional measures such as its peers in the US and Europe? Then Reuters, Alex Winning. Did the MPC consider risks arising from increased government borrowing, crowding out borrowing by private sector issuers? How large a move in the rand or sovereign bond yields would have the SARB considered a risk to financial stability, where it would consider intervening in the forex market?
Can you repeat that question? It says moves in the bond market, and then you must intervene in the forex market. You intervene in the market where there is a problem.
So it's Alex Winning. Did the MPC consider risks arising from increased government borrowing, crowding out borrowing by private sector issuers? Mm-hmm. How large a move in the rand or sovereign bond yields would the SARB consider a risk to financial stability, where it would consider intervening in the forex market?
Okay. Is that it? Isn't there?
That's it from the media for now.
Okay. Would we lighten regulation like the others have done? I think that the reference here would be where countries have got buffers. So one of the instruments in the macroprudential toolkit is the counter-cyclical capital buffer. It is an add-on requirement on banks to counter the financial cycle. In South Africa at the moment, the counter-cyclical capital buffer is 0. If we had it, we could have been considered that you can remove it. Well, we do not have it, so there is nothing to do with the counter-cyclical capital buffer. Would you enlighten regulations? Well, regulations get enlightened all the time depending on the circumstances. At the moment, as I had said, the banks are adequately capitalized and they are meeting all the regulatory requirements, and there is no pressure for us to enlighten regulation, and so it is not something that had crossed our mind. Lucanyo, how effective would monetary policy be? Well, we think that we have the step that we have taken and the magnitude that we have taken should actually have an impact. Unlike our peers in the advanced economies where interest rates are almost 0, we do not have that problem, and that is why we could make the move. But we could also make the move for the very simple reason that we have been able to build the space over time. This is not the first crisis that we are facing. There was a crisis in 1998. There was a crisis in 2001, followed by a banking crisis in 2002. There was the global financial crisis. In 1998, when the crisis set in, the Reserve Bank found itself in a bind. Inflation was going up at the same time as the crisis, and interest rates had to go up. So became pro-cyclical. But there was also the question of the credibility of the monetary policy framework at the time. When the 2001 crisis hit us, which had its origins in Argentina, the inflation targeting framework was in its infancy, and it was actually tested. Inflation did breach the target and was brought back within the target. When the 2008 crisis hit us, inflation was within the target And we had 8 years of experience in terms of implementing the inflation targeting framework. We had the fiscal buffers to respond to the crisis. And so both fiscal and monetary policy could provide stimulus to the economy. This crisis finds us better prepared from a monetary policy stance. For we have not just brought inflation down to the midpoint of the inflation targeting range, but inflation expectations are now anchored closer to that midpoint of our inflation targeting range. And then that tells us that we have that room, and that is what we did. We utilized that room. Risks of if the risks, or what would the risks to the rand and bond yields, at what point would we intervene? I don't see the rise in bond yields or the depreciation of the currency to be leading to financial stability risks. A rise in bond yields, yes, will make the banks to market their portfolio, and this time it is also impacted by the fact that there is the liquidity coverage ratio where they end up having to hold high-quality liquid assets, and so they have to mark those to market. With respect to the currency, again, we do not see the currency posing a financial stability risk. Why? Part of the big driver is that the South African banks, as per the prudential regulations, can only hold open positions in foreign currency up to a certain percentage of their capital and reserves. They are all within that. And so there isn't an issue of financial stability risk to talk about here. So we wouldn't be intervening in the markets because we are worried about the financial stability risks. In any case, if you are worried about financial stability risks, you deploy your macroprudential tools. You don't go and play poker in the foreign exchange market. There was a question about government which I didn't understand.
From Hillary?
No, from Reuters. What is it? The first one from
where the government borrowing, where are we concerned that government borrowing is crowding out private borrowing in the market?
Yes.
Well, that is not for us to make. There is no doubt that when government reduces its borrowing from the market, it opened the space for the private sector. At the moment, I can't say that we are seeing that crowding out. However, if there is concern that government would be crowding out the private sector, if ever there was a case for prudent fiscal policy, that is it.
Two more questions from the media, and then we can do the analysts, Governor. Ed Stoddard from Business Maverick. When were rates last this low? Business Times, Hillary. Do you foresee any need to provide liquidity support to markets, and would the bank be willing to do so if needed?
Monetary policy is about liquidity management. If we feel that the liquidity is drying in the market, we add liquidity. And if we feel that there is too much liquidity that might lead to inflation, we withdraw the liquidity. That is what monetary policy operations are about. And if we feel that there are potentially parts of the market that could be dysfunctional and might need central bank liquidity, it is part of our mandate. We would not hesitate to do that. We monitor that not on a daily basis, on a continuous basis. And we have got people who are watching